Picture this: a single rectangle of green paper. Mass-produced in vaults beneath Washington, D.C., it costs pennies to create, yet possesses the power to launch military campaigns, rescue economies, and dictate global commerce. No emperor commanded such authority. This is the U.S. dollar in 2026, a fiat currency that still reigns supreme. The paradox is stark. In an age of digital wallets and cryptocurrencies, why does the world revolve around this paper? The answer lies not in conspiracy, but in a history of necessity, trust, and self-reinforcing dominance. Its roots stretch back to the wreckage of the 20th century's two great wars. By 1944, Europe and Asia lay in ruins. Factories were bombed, gold reserves scattered, currencies worthless. The United States, by contrast, had become the world's arsenal and banker. It held roughly two-thirds of global monetary gold, its industrial base untouched, and its economy surging. Representatives from 44 nations convened at the Mount Washington Hotel in Bretton Woods, New Hampshire. They faced a stark choice: rebuild the world economy on chaos or create order. They chose order. America was at the center. The Bretton Woods Agreement established the dollar as the system's linchpin. It was convertible to gold at a fixed $35 per ounce, while other currencies were pegged to the dollar. The IMF would lend dollars to countries facing shortages. The World Bank would finance reconstruction. The logic was simple. Only the dollar had the depth, stability, and universal trust to anchor everything else. The system worked spectacularly. The Marshall Plan poured billions of dollars into Western Europe. Rebuilding cities and factories, global trade volumes soared. The 1950s and 1960s became the golden age. Low inflation, high growth, rising living standards across the developed world. Developing nations began to integrate, borrowing dollars to import machinery and fuel industrialization. For a generation, the dollar was synonymous with prosperity. But prosperity bred imbalance. The United States started spending more than it earned. Military commitments in Korea and then Vietnam escalated. President Lyndon Johnson's Great Society programs expanded domestic welfare. These twin pressures created chronic balance of payments deficits. Dollars flooded abroad, into the hands of central banks in Europe, Japan, and beyond. By the late 1960s, foreign-held dollars vastly exceeded America's gold stock. Confidence wavered. France, under Charles de Gaulle, openly demanded gold for its surplus dollars. The drain accelerated. On the evening of August 15, 1971, President Richard Nixon addressed the nation from the Oval Office. He announced the temporary suspension of dollar convertibility into gold, what history now calls the Nixon Shock. The Bretton Woods fixed exchange regime collapsed that night. Economists warned of impending disorder. Competitive devaluations, trade wars, a return to interwar chaos. They were mistaken. Far from disintegrating, the dollar found new life in the ruins of the old system. Floating exchange rates replaced fixed pegs. Currencies would now be valued daily by markets, a radical shift. Volatility spiked at first. Businesses scrambled to hedge risks they had never faced before. Yet the transition proved more resilient than anyone expected. Floating rates gave economies breathing room. When external shocks hit, currencies could adjust naturally instead of being defended at ruinous cost. Then came the defining event of the 1970s, the 1973 oil crisis. OPEC, led by Arab producers, embargoed oil shipments to nations supporting Israel during the Yom Kippur War. Prices quadrupled almost overnight. Oil-importing countries suddenly needed vastly more dollars to pay their energy bills. Oil-exporting nations found themselves swimming in dollar windfalls. What did they do with this tidal wave of revenue? They recycled it back into the U.S. financial system. Secret agreements ensured that OPEC priced oil exclusively in dollars and invested the proceeds in U.S. Treasury securities. This petrodollar recycling became the new pillar holding the dollar aloft. Gold was gone, but oil, the lifeblood of industrial civilization, now demanded dollars. The logic was inescapable. If you wanted energy, you needed dollars first. To earn dollars, you exported goods, attracted American investment, or borrowed from dollar-based banks. The dollar transformed from a gold-backed promise into the indispensable lubricant of global trade. Every barrel of oil sold reinforced its centrality. The United States unlocked its most potent advantage, the exorbitant privilege. Because the rest of the world needed dollars for trade and reserves, America could finance large deficits at exceptionally low interest rates. It could run trade imbalances year after year. It could print money to cover domestic priorities while exporting the resulting inflation to dollar-holding nations. Other countries had to earn their international purchasing power. The United States could create it. The 1980s tested this privilege. The dollar soared so high that American exports suffered and trade deficits ballooned. In September 1985, the G5 nations met at the Plaza Hotel in New York and agreed to intervene in currency markets to bring. It worked. The dollar depreciated sharply, easing pressure on US industry. A follow-up Louvre Accord in 1987 helped stabilize it. These episodes demonstrated something crucial, even in a floating rate world. The dollar's value could still be managed through coordinated power, and that power remained overwhelmingly American. The fall of the Berlin Wall in 1989 and the Soviet collapse in 1991 removed the last ideological rival to dollar capitalism. Emerging markets opened up. The euro launched in 1999 with great fanfare, uniting much of Europe under a single currency. Many predicted it would eventually overtake the dollar. It did not. The euro became a major reserve currency, but largely regional. The dollar retains its global monopoly. The ultimate stress test arrived in 2008. The subprime mortgage crisis erupted in the United States. Lehman Brothers failed. Credit markets froze. Global trade contracted at the fastest pace since the Great Depression. The natural expectation was that the dollar epicenter of the crisis would plummet. Instead, the world ran to it. Investors sold everything else and bought U.S. Treasuries. The Federal Reserve responded with unprecedented action, currency swap lines that provided hundreds of billions of dollars to foreign central banks, ensuring dollar liquidity worldwide. The Fed effectively became the planet's lender of last resort. Once again, in panic, the dollar proved itself the safest asset on Earth. By February 2026, the dollar's dominance has become quieter, more structural, and in many ways, more unassailable than ever. De-dollarization headlines appear regularly, yet the underlying data remains stubborn. According to the latest IMF figures, the dollar still comprises about 58% of allocated global foreign exchange reserves. It accounts for roughly 60% of international debt securities and dominates foreign exchange turnover in most major pairs. More than half of global trade invoices, even between non-U.S. countries, are still written in dollars. A Chinese factory selling electronics to Brazil, or an Indian refiner purchasing Russian crude, will frequently settle the transaction in dollars through correspondent banks in New York or London. This persistence is not inertia. It is network effects at their most powerful. The dollar is embedded in an ecosystem no rival has replicated, the deepest, most liquid government bond market on the planet, the most sophisticated and reliable payment rails, the largest pool of dollar-denominated assets for collateral and investment, a central bank, the Federal Reserve, that has repeatedly demonstrated willingness and capacity to provide emergency dollar liquidity to the entire world. Sanctions provide the starkest illustration of this power. In 2022, following Russia's invasion of Ukraine, the United States and allies excluded several major Russian banks from SWIFT and froze hundreds of billions in dollar-denominated reserves. Russia's economy contracted sharply. Its ability to finance imports and service debt was severely impaired. The message was unmistakable. Access to the dollar system is now a privilege that can be revoked, and revocation can be more devastating than many military strikes. China, Russia, India, and other BRICS members have responded by accelerating alternatives. Yuan-denominated trade settlements have grown, especially along Belt and Road corridors. BRICS summits have discussed cross-border payment platforms and CBDC interoperability. Russia and Iran have used gold and national currencies for some bilateral trade, yet these efforts remain fragmented. The renminbi's global reserve share hovers below 3%. Most countries continue to accumulate dollars because they are the most liquid, most trusted, and most universally accepted asset available. No other currency combines safety, depth, and convenience at the same scale. The dollar's endurance carries a deeper implication. It rewards the issuer with extraordinary flexibility, the ability to sustain deficits. fund military commitments, and weather domestic crises without immediate external constraint. But it also breeds resentment. Developing nations, forced to hold large dollar reserves as insurance against volatility, effectively lend cheaply to the United States while facing higher borrowing costs themselves. When the Fed raises rates, as it did aggressively in 2022 to 2023, emerging markets suffer capital flight, currency depreciation, and debt stress. History reminds us that no reserve currency is eternal. The pound sterling once held the throne. Before that, the Dutch guilder. Each fell as economic gravity shifted and trust eroded. The dollar is not immune. Yet for the foreseeable future, it continues to provide the world with something irreplaceable, a common language of value in a deeply divided age. The final insight is almost poetic in its simplicity. In the 21st century, real power is not measured by the size of armies or the extent of territory. It is measured by how many people, companies, and governments have no realistic choice but to use your money to conduct their daily lives. Right now, and for as long as the network holds, almost everyone still needs the dollar. Thank you for watching until the end. If this documentary opened your eyes to the hidden forces shaping our world, please hit that like button, drop a comment with your thoughts, and subscribe if you haven't already. Turn on the bell so you never miss the next deep dive into money, power, and the systems that quietly run everything. See you in the next one. Stay curious.